today's video, we're going to talk about some of the opportunities that we believe are being created because of the Federal Reserve increasing interest rate as they did yesterday, 25 basis points. And this is also, we believe, is causing bank failures. We're going to go into detail about some of these bank failures. We're also going to go into what type of opportunities that these create and how you can take advantage of turmoil in these type of markets. These opportunities only come around maybe every once in a while, and we believe that this may create or turn into a pretty deep and dark downturn that we can have in the stock market that you can take advantage of that crisis. And we believe that the market is in crisis mainly due to regional banks, and a lot of it having to do with the Federal Reserve raising interest rates, which is what we're going to go into. But before we go into what is the reason for that crisis, we want to talk about how we can take advantage of that crisis, and then we'll go into the reason for that crisis. What we should do to take advantage of that crisis is we should be prepared to have a list of long-term assets that we're willing to purchase as the stock market goes down. So we want to have good companies that will not be affected by the banking crisis that we're going to have in the overall stock market and how far it may go down. So we want to be able to buy good companies that has come down because of the crisis, and we can have the opportunity to buy those companies or stocks at good prices, which is a rare opportunity that only comes around every once in a while. That crisis started because of the banking crisis. And here's the reason why for that banking crisis, a couple reasons. First is that there's a run on banks and the speed at which you can have that run on a bank. In the past, you used to have to go stand in a line to withdraw out your money. Today, you can pick up a cell phone. You can withdraw, you can move money from one bank to another in a matter of seconds or a matter of minutes, which is going to bring down the overall deposits of the money that is in the bank that you currently have. And if it's a bank that you have that's in crisis at the time, how Silicon Valley Bank was, and there's some really good banks out there that are now watching their stock price go down. Some people believe it's because of ETFs. Some people believe it's because of short selling, but it doesn't really matter the reason. All we know is that the stock prices are going down and people are starting to get fearful about that. And some really good banks that we liked at one time before this crisis started is Key Bank, Fifth Third Bank, which are some Midwestern banks that don't have a lot to do with what's going on out there on the West Coast. But these banks are going down in sympathy to the overall regional banking crisis that we are in. We talked about the speed. Now it's the long-term bonds and loans that they have sitting on their books. So when the Federal Reserve lowered interest rates down to zero for a couple years, banks were making loans and they were buying bonds that had 1 or 2% returns on those long-term bonds. Loans, some bank loans with 2 or 3% home loans. So they have these loans sitting on their books. Now that the Federal Reserve increased interest rates to over 5 to 5.25%, it's easily to go on into a money market fund or a CD and get 5%, 5.25% on some type of short-term bond or CD or money market firm that you're looking from. So these banks, to try to not have those withdrawals come out, not even because of fear, but because people can get a higher return on their deposits, they're moving that capital over from deposits to some type of CDs, which the banks can no longer count as deposits and they can count towards their loan. So if they have to increase their percentage, which they was playing close to zero for capital that you had sitting in banks, if they have to pay 3% on the capital that they had and they're only getting a return of 2% from some of their long-term bonds that they're holding, you can tell that those are losing bonds that are sitting on their books. That's hurting a lot of regional banks at this time right now. One company that we wanted to use as an example that's not a bank that we believe that may have some trouble ahead is Charles Schwab. And what happened, we believe what happened with Charles Schwab, a lot of it has to do with zero trading. Back a couple years ago when a lot of the smaller brokerage firms was going to zero trading, Charles Schwab decided that they needed to go to zero trading, and they were zero trading and will focus more of their income on type of interest rate products. So what I mean is that, so the capital that you had sitting in your account that wasn't invested in stocks, Charles Schwab was investing that And as with regional banks and with banks, they were investing that capital in interest loans, mortgages, things like. So now they have the same problems that a lot of these regional banks are having. And interest rates is the main source of Charles Schwab's income since they went away from trading as one of their main revenue drivers. And because of that, Charles Schwab is having to offer higher rates to their depositors to try not to get that capital to flee from their it makes this opportunity overall important in this time. We don't believe it's time to buy as of now, but there's only been, as an investor of 30 years, there's only been 3 other occasions that I believe that's coming up as an opportunity that we may have coming. So that's one of the reasons why long-term investors that act like business men or women need to make sure that they're prepared to take advantage of this opportunity that I believe that we're going to have. We had this opportunity in 2000. We had this opportunity in 2008, 2009. We also had this opportunity when at the beginning of COVID, when the stock market first started to drop before the government came in and bailed a lot of things out. So again, you need to have the companies that you're prepared to purchase that you do not believe that will be affected by the overall banking crisis over the long term, that you're ready to purchase in the short term because they're creating a great opportunity for you to be able to purchase these shares.